A decade ago, calculating music revenue meant counting physical albums shipped to stores. Today, releases fracture into dozens of digital microtransactions instantly. Labels track payouts from streaming platforms, collect synchronization fees from placements, and still account for physical sales. On top of that, they must calculate mechanical royalties, the complex, mandatory payments owed to publishers and songwriters every time a track is digitally reproduced or pressed onto a physical format. What used to be basic multiplication at the end of the month has turned into a massive administrative burden. As a label's catalog grows, the volume of these microtransactions quickly outpaces a standard spreadsheet. If these calculations fall behind or contain errors, artists notice. Late or inaccurate statements damage trust with your roster and expose the label to serious compliance liabilities. Eventually, grower labels reach a breaking point where they have to decide exactly how to handle this operational bottleneck. One option is building an internal department. This requires purchasing an enterprise software license, maintaining IT infrastructure, and paying a full-time royalty accountant's salary. The alternative is passing the entire process to a specialized firm. Instead of building the infrastructure yourself, you pay a monthly retainer or a percentage fee to an outside team. Keeping it in-house gives your executive team direct, immediate control over every single row of financial data. Outsourcing replaces sudden hiring expenses with predictable monthly costs and gives you immediate access to a fully trained staff. Ultimately, this choice dictates how a label allocates its capital. You have to decide whether to spend your budget building administrative infrastructure or aggressively expanding your creative roster. This comparison matrix breaks down the operational burdens of both approaches, starting with the infrastructure column. Licensing professional royalty software requires a high fixed payment. You pay that strict overhead whether you release 10 albums this month or 0. By outsourcing, you drop the software maintenance entirely. Your infrastructure cost becomes a flexible service fee that often scales directly with your actual release schedule. Then there is the issue of reading the contracts themselves. Translating non-traditional deal structures and producer percentages into a database requires specialized knowledge. Recruiting that specific skill set demands a highly competitive salary. An external agency gives you those specialists on day one, though you lose the convenience of an in-house accountant. You are trading rigid fixed overhead for specialized talent that lives outside your building. This diagram shows the data operations workflow, highlighting how a label handles its massive sales history. Downloading statements from distributor portals, scrubbing metadata, and validating third-party sync income consumes huge amounts of internal team bandwidth. Outsourcing shifts that tedious ingestion process to an external firm, freeing up your staff schedule. But that convenience comes with a trade-off. You are relying heavily on a third party's reconciliation reporting instead of auditing the raw data firsthand. You have to choose between protecting your team's operational bandwidth and maintaining absolute visibility into the raw numbers. Finally, this matrix covers the last step in the process, generating statements and managing payouts. When reporting months hit, internal teams experience immense administrative stress trying to process everything on deadline. External firms handle this surge, guaranteeing statements are compliance checked and payments are distributed promptly. But this is the final touchpoint with artists. Even if the statement is custom branded, you are placing a sensitive relationship in an outside vendor's hands. It comes down to whether direct control over artist relationships outweighs the safety of guaranteed administrative compliance. This decision scorecard breaks down which path makes sense based on your label's current size, catalog volume, and deal complexity. We categorize the startup label as an operation with low catalog volume and simple, traditional record deals. If you are in this stage, preserve your cash flow, avoid expensive software and external agencies. Stick to manual spreadsheets until your volume actually forces you to upgrade. The scaling indie has a growing catalog, uses non-traditional deal structures, and employs a staff that is already short on time. For these labels, outsourcing royalty accounting is usually the most effective move. Avoiding the fixed cost of a new hire gives your core team the immediate freedom to focus entirely on A&R and roster growth. The enterprise label operates with massive global catalog volume and deep financial pockets. At this volume, economies of scale take over. Enterprise labels should build their operations in-house, as their size justifies the heavy fixed overhead required to secure total, immediate data control. Whether you crunch the numbers yourself or hire a firm to do it for you Your accounting strategy needs to match your operational agility. Pick the path that actually supports your long-term growth.